Guys, this will be I have no idea, I've done many videos now, but today we're going to be looking at Big Lots Inc., ticker symbol BIG, trading at a $66 million market cap. This company is going through bankruptcy, and there's many issues. You can see here that this company went from having a $70 share price to now being $2.26, trading for a $66 million market cap. And there's many reasons for that. Of course, I'm going to start the video off, and particularly for this stock is I just want to say that if you're investing in Big Lots, there's a high risk that your investment goes to zero, and this video is not financial advice. I'm going to start a new series on looking at bankruptcy stocks and seeing if these companies can make it another year. And investors realize that, and these stocks could have major upside, but the only risk is your investment could go to zero. All right, guys, let's get right into the video. Alrighty, so I went over here to my Excel. It would not be a stock video if there was not an Excel. Okay, so we're just gonna look at the basics of this company. And here's some things that I found reading the earnings call, and I felt like this is just easy to have it here instead of me going through all the SEC filings. But when we're looking at bankruptcy, guys, there's two main types of bankruptcy that these companies see. It's Chapter 7 bankruptcy and Chapter 11 bankruptcy. Now, which you guys probably both heard of, Chapter 7 bankruptcy is when the company liquidates all its assets and it closes down. On the other hand, Chapter 11 bankruptcy is when, you know, the company negotiates with its creditors, and maybe they make the loans, the maturities out longer for those loans, but the company basically operates and all interest payments, pause. And all whatever the creditors are, it pauses, but the company is still running as they're in bankruptcy court, trying to negotiate and basically make it out a better company at the end. Usually that happens. Sometimes you see it with companies like Hertz, Tuesday Morning. I'm trying to think of other ones, but I've seen it multiple times. And most of the time when that happens, Chapter 11 bankruptcy, about 99% of the time, the equity holders, the shareholders get absolutely nothing. The only time they do is when there's actual equity in those shares. Um, and I've played some of these stocks like Hertz. There was equity in the shares, and then I think there was like some sort of deal with the I think it was like 2 shares or something that they got of the new common stock. But anyways, let's get on Big Lots. So the first thing we're going to talk about, guys, is when you're looking for bankruptcy risk, there's basically 3 main things you want to look at. Is you want to look at current assets, current liabilities, and liquidity. Because those 3 things, right? Current liabilities, if you don't know what that is, current liabilities is basically debts that need to be paid in that year. And obviously, if you don't pay your debts or your liabilities, you go bankrupt. So you want a good amount. You want more current assets than current liabilities. So first, we see that here they have $1 billion of current assets, and they have 831 million of current liabilities. So that is a good sign. So they do have enough. If they sell these current assets at a fair value, then they have enough to pay these current liabilities. And another thing is 953 million of those current assets are inventory. I could not see what the inventory is, but depending on what it is, that could also factor in, because if it's mostly furniture, then that's not very good. But if it's like food or something like that, that's very liquid, that's going to sell in your stores, then obviously it's going to be easier to sell. I don't know how much of that is bad inventory. They only have 46 million in cash, and the rest is other current assets, so $86 million. So this company is, it looks fine. And then also when I'm reading the earnings call, they say, looking at their liquidity, they have 254 million of net liquidity, similar to Q3. And we can see here, we have the ability to monetize up to 200 million of remaining owned assets. So this company does have enough liquidity to basically, from what I'm looking at, is at least survive the year. Now that does not take out that Chapter 11 bankruptcy risk, which could be possible. There was a somebody put out a price target that basically said that this company, I think they put a price target of $1, I think, and they said this company hired a consulting firm to basically look at their business because things aren't going the way it should be and their business could be in much trouble. I'm not sure when their next earnings report comes out, but that could be huge. Another thing with this company that they mentioned was something about this Hirschlong Toys they bought out for 22 million through a foreclosure sale. But if you're looking at this company for real, 22 million, this company has I think 3.3 billion in assets. Is if they sell this at a profit, maybe they get 2x. That's 44 million dollars. Is that really enough to make a dent into this company? No. Another thing that this company talks about, and I want to go over, this is one thing that I want to go over, is the tangible asset value. If you're not aware of the tangible asset value, basically takes your tangible assets minus your liabilities, and then and that's it. And that is your tangible asset value, or most of the time I call it the fair value because, when most stocks gravitate towards that value if the company is losing money, and it might actually trade under if the company is losing money. But let's just look at these tangible asset value, and we could see how much this company has deteriorated. So they had 1.2 billion in tangible asset value in 2021. 1 billion, so we see 200 million lost. 763 million, and now it's all the way down to 284 million dollars. And one of the reasons for that is because they are doing basically writing off these bad leases. I think they call it ghost leases or something like that, but they are writing them down like crazy. And let me go over to my other screen, which basically shows their EPS. So 1 second. So here is the 2-year chart of their EPS, and we could just see how quick and how these write-offs are just deteriorating this business. They made about $5.33 in, obviously, for that quarter. And you can see here, -7, -14, -20, -15, -16. So we could just see here that this company is doing these write downs, and it is killing the fair value of this company. And that's why you see this diving here. Almost 78% decline from 2021. All right, let's go back. And then obviously it looks like their main growth for the business is they are trying to do these bargains to brag about, which if you haven't been to a Big Lots, I mean, they have some great deals. I went there the other day, and there's products there that are, selling like 10 to 20% less than a retailer like Kroger or Walmart. So they are doing these big deals. And I think I drove by there the other day, and they had a 30% discount on all products. I think it was like 30 to 20% discount on all products for friends and family. So they're doing these huge discounts, and it looks like that's what they're positioning the business for, which doing huge discounts is not, a great thing, but because obviously if you sell your products for less, your margins are lower, and it destroys the business. And I think the company is currently losing money. I think they reported a net loss of like negative $31 million, so it is continuing to lose money. And this is another thing too, is like this guy is talking about, right? We took over 140 million of SG&A during the year, cut capex by almost 60% year over year, reduced inventory by nearly 200 million. If we just look at this part, right? It's very easy to cut your capex and your SG&A when you're doing a bunch of write-downs. Like, if you do no write-downs during the year compared to those other years, of course your SG&A and all that's going to look much cheaper because, well, you're not doing these huge write-downs of, like, I remember, I think it was I think 2023 Q1, I believe, they did $80 million in write-downs in one of these bad leases in one quarter. 80 million. Um, so it's just crazy how fast this company has deteriorated. I don't know what happened. And another thing is here, as we could see here, the interest expense. Oh, here it is. During the first quarter, the company recorded, this is what I was talking about, impairment charges of 83.3 million related to 237 underperforming store locations, which were comprised of 62.1 million of operating lease rights use of assets and 22.4 million of property, plant, equipment net. So we can see here that they're canceling these leases, and it's crazy. I don't know what the fuck's going on. I mean, excuse my language. I don't know what the hell is going on. And we can see here interest expense increased to 24.5 to 44. So it's obviously interest rates going up, and the interest expense is fucking skyrocketing too. And then you can see more borrowings too is probably also driving that also. But this company is looking like it could be heading into bankruptcy. And we're going to talk about the upside here, and we're going to talk a little bit about these stocks. So when we're talking about these companies, it is very high risk. I want to say that too, as I said in the first part of the video. But these companies, if they can figure out a way to become profitable, then this stock will probably go to about $10 a share within a week. So your upside is about 342%. Now, obviously, if Chapter 11 happens and they go bankrupt, you will lose 100% of your money. The short interest is only 22%. So obviously, if they don't go bankrupt, shorts are going to cover their position, which could cause a short squeeze. Um, it's possible, like we've seen with GameStop, Express, Bed Bath and Beyond, and these companies that obviously, you know, survived another year, and then the stocks obviously ramp up, and that's what we're going to be looking for in this series of bankruptcy stocks. So, is this stock a buy? In my opinion, I think if you were going to gamble, I have a 30% odds of going bankrupt. Now, the odds of them actually becoming profitable, I don't know. That'd be a whole different thing to look at. But if you guys have any other information, with the information that we have right now, with looking through the SEC filings, and with no new developments on the date of 6/11/2024, this is where I see the stock a 30% chance of bankruptcy. And of course, this could change if tomorrow something comes out that you know, they did a new they got some new debt or something like that, that would actually lower the odds of bankruptcy because they got more liquidity. Or if earnings come out and they start losing a bunch of money again, then that also changes the odds. All right, guys. Well, this will end the video. Like and subscribe. And if you have any other information on the stock, please post it in the comments.